The New York Fed just made phone calls that could crash your portfolio. They're preparing for something that hasn't happened in 15 years, and almost nobody is talking about the truth. So, if you're short on time and refuse to listen to some random cat guy on the internet, fair enough. Here's the 1-minute version. For decades, investors borrowed dirt cheap yen from Japan and funneled hundreds of billions into US markets. That money helped prop up stock prices. Now Japan has raised rates to their highest in 30 years, bond yields are spiking, and the Fed is running rate checks. That's a warning signal for potential currency intervention. If the yen spikes hard, expect a fast 5 to 15% drawdown. High multiple growth and tech names get hit hardest. But historically, these panics create buying opportunities once the dust settles. Watch dollar yen and the VIX. Those are your early warning indicators. There, now you can leave. Or you can stick around and actually learn more about the mechanics behind this, so you'll not get caught off guard when headlines start screaming about yen carry trade unwinding. So, hey, I'm DataCat, welcome back if you've been here before. And if you're new, well, a quick intro about myself. I spent some years as a very average corporate analyst inside a Fortune 50 company. You know, living the dream. And by dream I mean daydreaming with 4 cups of coffee. Basically I was like a cat, except instead of napping 18 hours a day, I was doing the opposite. 0 out of 10 would not recommend. This channel is about 6 months old. I'm not here to sell you a course. I'm not here to tell you I've got some secret alpha. I'm just a guy who reads a lot of research and happens to enjoy explaining things. Also, I have a slight obsession with cats. You'll notice. Anyway, today we're covering something most retail investors completely overlook: how Japanese monetary policy directly affects US stock valuations. This is the stuff Wall Street analysts discuss in morning calls but rarely bother explaining to regular people. So let's fix that. But first, let me paint you a picture. Imagine you have a friend. Let's call him Neko-chan. And Neko-chan is extremely generous. He'll lend you money at almost 0 interest, like 0.5%. Meanwhile, you know you can put that money into a US savings account paying 4%. So what do? You borrow from Neko-chan, convert the yen to dollars, park it in that savings account, and pocket the difference. Free money, right? Well, sort of. This is the yen carry trade in its simplest form. And it's not just individual investors doing this. We're talking hedge funds, massive banks, institutional players moving hundreds of billions of dollars. It's been one of the most popular trades in global finance for literally decades. Now here's why you should care, even if you've never touched a yen in your life. All that borrowed Japanese money flows into US markets. It buys treasuries, it buys stocks, it provides liquidity, it helps keep US interest rates lower than they'd otherwise be. Think of it like this. Japan has been subsidizing American asset prices for years. Not intentionally, but effectively. Every time a fund borrowed cheap yen and bought US stocks, that was buying pressure supporting your portfolio. The problem? This only works when conditions stay stable. When they don't, well, the money flows out just as fast as it flowed in. And unlike cats who gracefully land on their feet, markets tend to faceplant pretty hard. So there are 2 ways this whole thing can go sideways. Let me walk you through both, because they create very different problems for US stocks. The first scenario is the sudden shock. Picture this. You borrowed in yen, you're invested in dollars. If the yen suddenly strengthens against the dollar, you've got a problem. You still owe yen, but your dollar investments are now worth less in yen terms. Your free profit just became a loss. What happens next is basically a stampede. Everyone with this trade rushes to close it at the same time. They sell US assets, stocks, bonds, everything liquid. They convert those dollars back to yen. They pay back their loans. And here's the nasty part. All that yen buying makes the yen even stronger, which makes the losses even worse, which triggers more selling. It's yet another feedback loop, a vicious one. US stocks can drop 5 to 15% in days or weeks when this happens. The second scenario is the slow squeeze. This is what happens when Japan gradually raises interest rates. Borrowing in yen becomes more expensive. The profit margin on the trade shrinks. Some investors decide it's just not worth the risk anymore and quietly exit. This doesn't create panic, but it creates steady selling pressure over time. It also pushes up interest rates globally, because remember, Japan is one of the world's largest lenders. When Japanese capital stays home, there's less money chasing American assets. Stock valuations compress, growth stocks suffer. It's like a cat slowly pushing your coffee mug toward the edge of the table. No sudden crash, just relentless methodical pressure until something falls. Okay, so here's the situation as of January 2026. Japan is changing. For years, they were the predictable part of global finance. Rates pinned near zero, yen staying weak, carry trade humming along smoothly. That era is ending. The Bank of Japan raised rates to 0.75%. Doesn't sound like much, right? But that's the highest in 30 years. Which, when you come to think of it, is an entire generation of traders has never operated in a world where Japanese borrowing costs actually mattered. Japanese government bond yields are at multi-decade highs. The 10-year is sitting around 2.2%. The 30-year is at roughly 3.6%. This means Japanese investors can now earn decent returns at home. They don't need to send their money abroad anymore. To add into this context, here's something that just happened. The New York Federal Reserve recently conducted what's called a rate check on dollar-yen trading. They called up market participants asking where dollar and yen was trading and where they could deal size. Now, a rate check isn't the same as intervention, but it's commonly interpreted as a warning shot, a signal that authorities are watching closely and preparing to act if needed. This would be the first joint US-Japan currency intervention in about 15 years if it happens. That's significant. Meanwhile, Japan's government just passed a record budget of 122 trillion yen. More government spending means more bond issuance, which means potentially even higher yields, which means even more pressure on the carry trade. We're in this weird transitional period where the carry trade is under pressure but not collapsing. It's a gradual unwind, not a panic, but the risk of a sudden shock is elevated. Any surprise, policy announcement, intervention, global scare, exactly what we've been experiencing over the past few weeks could trigger that stampede scenario. Now, to better understand this, let me give you some context because this pattern has repeated before. For example, back in early 2016, China growth fears were rattling markets. The Bank of Japan surprised everyone with negative rates, which actually confused investors instead of calming them. The yen strengthened in all that uncertainty. And the result? US stocks corrected more than 10%. Volatility spiked, and this wasn't even a full-blown crisis, just uncertainty about central bank policy combined with risk-off sentiment. Then we have March 2020, the COVID panic. Everyone sold everything for cash simultaneously. Funding markets seized up. Even so-called safe havens failed temporarily. We saw the fastest 30% drop in stock market history. The recovery only came after massive Federal Reserve intervention. The pattern across these episodes is remarkably consistent. Some shock occurs, risk appetite drops, investors reduce leverage, carry trades unwind. The yen strengthens. Yen strength causes more losses, which triggers more selling. US stocks fall, volatility spikes, credit spreads widen. Eventually it stabilizes, usually after some policy response. The key insight here is the yen carry trade is rarely the cause of a crisis, but it's almost always the accelerant. It makes things worse and faster. It's like, you know how a cat can knock over one thing and somehow that causes 5 other things to fall? Same energy, except the things falling are your retirement accounts. So what do you actually do with this information? First, don't panic. The carry trade is unwinding gradually right now. We're not in crash mode, but stay alert. Watch the dollar-yen exchange rate. Watch the VIX. Pay attention to Bank of Japan headlines. If you see the yen spike 3% or more in a few days, that's your signal that the stampede might be starting. Second, understand your exposure. High growth, high multiple stocks are most vulnerable here. They get hit from both channels. The slow valuation squeeze from higher global rates and the sudden sell-off if volatility spikes. If your portfolio is heavily concentrated in expensive tech names, you're more exposed to this risk than someone holding diversified value stocks. Third, remember the historical pattern. Yen strength plus volatility spike often equals buying opportunity after the dust settles. These episodes are scary while they're happening, but they've historically been followed by recoveries. The key is not panicking at the bottom. Look, I can't tell you exactly when or if the yen carry trade will blow up. Nobody can. What I can tell you is that this is a real force affecting your portfolio right now, and most people have no idea it exists. Now you do. Use that knowledge wisely. Alright, that's the situation with Japan, the yen, and your US stocks. I hope this actually made sense and gave you something useful to think about. If it did, consider hitting that subscribe button. I'm still a tiny channel, like a clumsy British short hair trying to compete with lions over here. So every subscription genuinely helps. And if you found this valuable, drop a like so the algorithm shows this to other people who might benefit. I'll keep putting out these kinds of breakdowns, the structural market stuff that doesn't get enough attention. No hype, no courses, just analysis. Thanks for watching. Remember to stay vigilant and skeptical. DataCat out, and I'll see you in the next one.